What's up, everyone? It's Caddy with Money Vesting. So Tom Lee for Fundstrat Global Advisors pretty much suggested that bears are right now, quote, trapped, and they can soon turn from being bearish to bullish on the market, which can surge the S&P 500 to new heights. So hope you guys are doing great and are enjoying your day. Make sure that you drop a like and subscribe to the channel if you haven't already. The link to our Discord and Patreon is going to be down below if you're interested in joining us. 16% annual discount available till the end of this month. After that, it will go away. And in this video, I wanted to talk a little bit more about where or how hedge funds have positioned themselves. And they are, in fact, the most bearish in over 10 years. And what Tom Lee thinks about that as well. So again, links are going to be down below if you're interested in joining us. Without further ado, let's just dive right into it. So first things first, Liz Young tweeted about 7 hours ago, although it unwound a touch this past week, speculative positioning on S&P 500 futures remains the most bearish in over a decade. So again, we're coming back to as far as 2011, and that's a little bit over 10 years, 11 years, where S&P 500 futures have not really been net short to a level as we are seeing right now. So we are extremely, in other words, we as in market participants in general on an aggregate basis are still very much net short at the moment, despite the moves for the markets higher from back in October. So we have seen the Nasdaq, the S&P 500 rally quite a bit from those levels, despite taking heavy bets on the downside of the market from hedge funds. Now, Tom Lee pretty much mentioned that bearish investors are, quote, trapped after stocks has flashed another sign of a new bull market has begun. So he mentioned that stocks just flashed yet another signal that suggests a new bull market has begun. According to Fundstrat, the S&P 500 is near 20% rise since its mid-October low, has trapped bearish investors that expect a hawkish Fed. And he says, and I quote, if inflation falls as quickly as we expect, the Fed will tolerate easing financial conditions. And he mentioned that stock market has flashed another bull signal that suggests new bull market has arrived, leaving bearish investors are trapped, according to Fundstrat's Tom Lee. And Lee highlighted that a growing chorus of warnings about a hard landing and imminent recession is falling flat as inflation shows signs of easing and the job market remains resilient, hinting that the possibility of an actual recession could have already come and gone. In other words, a rolling recession. He mentioned that the issue is that this has become the most widely anticipated recession ever, which raises the question whether a rolling recession has already passed. And that sets the stock market up for more gains, following S&P 500 is near 20% rally from back in October, with yet another bullish technical signal suggesting that the year-long bear market has flipped to a brand new bull market. And that is going to be the moving average, the 200 weekly moving average. And now the S&P 500 has spent more than 25 weeks above the 200 weekly moving average since 1950. There are 0 instances of S&P 500 making a new low once it has recovered above the 200 weekly moving average and spent at least 15 weeks above its 200 moving average. So if you go over to the S&P 500 right now and go over to the weekly time frame, and I'm going to actually turn off all the other ones, just simply keep the 200 SMA. So what you'll notice is the 200 simple moving average, we kind of dipped below back in October. And from that level, we have pushed higher. And it's been well over 25 weeks. The S&P 500 has managed to close and trade above its 200 weekly moving average. This right here was another time when it broke down below the 200 SMA. And Tom Lee is going back even further. So you can kind of see that we were below that level during the great financial crisis, during the housing bubble. And immediately we kind of pushed back up. We consolidated sideways. But again, you kind of see over here, once we break past to the upside, it does feel like this is 25 weeks, right? We didn't quite make a new low, but we did sell off over here. So you'll notice 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. Yeah, this is definitely 25 weeks. The S&P 500 was above its 200 weekly moving average. So yes, if you take it out at face value, we didn't quite make a new low, but we still did drop here. This was right here, 20% drop in the S&P 500 in May through October of 2011. And that resulted in obviously the markets coming down to a bear market again. And then, of course, rallying all the way to higher highs and, of course, making a new all-time high. So the statement that once the market is above its 200 weekly moving average for 25 weeks in a row, the market's never come down to a new low is technically correct, but that doesn't suggest the market's selling off down to its 200 weekly moving average again, or pulling back 10-20%. The market doesn't have to come down to a new low. The market can still drop 10-20% without coming down to a new low. So that is something to keep in mind for S&P 500. This right here is another instance where you'll notice that, of course, I mean, we did have a new bull market start when it started to break past that 200 weekly moving average, and we continue to rally even further with, of course, pullbacks every so often. And this right here, very, very strong, consistent rally of validation of that 200 simple moving average. And now we're going back to the 1970s. Again, we broke down below this level. There was a recession. There was obviously a bear market and a full-blown crash at the time. And this right here was also that same time period where we did push back higher. We stayed 25 weeks above that level and then dropped another 15-20% for the market. So there's definitely some truth to this analysis that a new bull market has started because the markets are above its 200 weekly moving average. But the signal has a 100% win ratio according to Lee, with 1, 3, 6, and 12-month returns being positive every single time the S&P 500 passed the milestone of remaining above its 200 weekly moving average for 25 consecutive weeks. On October 12, 2022 is the low price of this cycle. And he added that this views have been strengthened by other bullish signals, the rule of first 5 trading days and 2 consecutive quarters of stock market gains during a bear market. And the rising stock market, amid a barrage of negative economic headlines, has trapped a lot of bearish investors who are positioned for more downside in stocks, not upside. In fact, hedge funds and those bears could easily be slowly starting to capitulate and flip to the exposure from being bearish to bullish, which obviously going to fuel this rally even further. And he reiterated that the S&P 500 will surge another 15% from current levels to 4750 by the year end. So quite an interesting analysis, and let me know your thoughts down in the comment section below. I do believe from a technical macro seasonality perspective, yes, there's a lot to look forward to in terms of markets pushing higher. There's a lot of bullishness, no doubt, but we are approaching a very critical area of resistance, as I've already pointed out, between 41 and 4200. That's going to be the level to see whether we break past that level or if we start to pull right back down, because earnings are going to be the main key takeaway from here. But that being said, from a long-term perspective, I'm still long, I'm still bullish, I'm still invested very heavily in the market. So yes, if the markets do end up going higher, that's great, but I'm still going to be quite realistic about what my assumptions, what my analysis is going to be. So recession-wise, there's a lot of other indicators that are starting to show signs of weakness. I mean, we did get retail sales numbers coming down in the last couple of months. How do you explain that? We did see a decline of about 1%, if not more, and real retail earnings, real retail sales after the inflation adjusted is down even further, and they've been selling off quite consistently over the last several months, and earnings in terms of average hourly earnings are not increasing at the same rate as inflation. So there are still expectations of a potential recession in the economy. We'll find out, of course, soon enough. So I'm going to be very cautious here, but still long, still invested to the upside. We'll continue to monitor that as well. Let me know your thoughts down in the comment section below. But just want to point out that this actually, can be seen or can be viewed as being more bullish than bearish, because just because hedge funds are net short doesn't necessarily mean that we're actually going to sell off. In fact, it could mean the quite contrary, where we end up rallying as we see that flip happen, and hedge funds start to capitulate and start moving their exposure on the long side for equities. So let me know in the comment section below. As always, if you enjoyed this video, found it helpful, make sure that you drop a like. Don't forget to subscribe to the channel. If you're just joining us for the first time, the link to our Discord and Patreon is going to be down below. 16% annual discount available till the end of this month. As always, happy investing, and I'll see you all in the next video.